Verizon Communications is one of the largest telecommunications companies in the United States, with its core businesses centered on wireless communications, broadband, fiber, enterprise connectivity, and related digital services. The 2026 and 2027 investment story is increasingly becoming a turnaround plus income story rather than a pure growth story. Verizon is working to improve wireless subscriber momentum, integrate its Frontier fiber assets, reduce costs, expand broadband, and generate stronger free cash flow while maintaining one of the highest dividend yields among large U.S. telecom companies. As of August 2026, VZ is trading around the $49 to $50 area, making valuation and dividend income particularly important to the investment case. Verizon generated approximately $138.2 billion of revenue in 2025, and its scale remains one of its biggest competitive advantages. The company operates an enormous wireless network and has been expanding its fiber broadband footprint through the Frontier acquisition. Management is also attempting to simplify its wireless pricing and improve customer retention. In the second quarter of 2026, Verizon added 184,000 postpaid wireless phone customers, significantly better than the roughly 104,000 analysts had expected. This is important because subscriber growth has historically been one of Verizon's weaker areas relative to T-Mobile. Verizon reported approximately $34.3 billion of revenue in the second quarter of 2026. Adjusted EPS came in at approximately $1.30, ahead of analyst expectations of around $1.28. Revenue was weaker than expected primarily because of lower equipment sales, but profitability benefited from cost reductions and lower device subsidies. The company also reported $10.2 billion of free cash flow during the first half of 2026, compared with $8.8 billion in the first half of 2025, representing approximately 16% growth. Capital expenditures were about $8.2 billion through the second quarter. One of the most important elements of the Verizon turnaround is cost efficiency. Management previously identified approximately $5 billion of operating expense savings targeted for 2026, supported by workforce reductions, business rationalization, and operational simplification. The goal is not simply to cut expenses, but to redirect some of those savings toward higher quality revenue opportunities. If Verizon can combine modest revenue growth with sustained cost savings, EPS and free cash flow can grow faster than revenue. That operating leverage is one of the strongest arguments for owning VZ through 2027. For 2026, Wall Street's current consensus is roughly $140.9 billion of revenue, representing about 2% growth from 2025. For 2027, consensus estimates are around $143.3 to $143.6 billion, implying another approximately 2% increase. My base case model is slightly more conservative, forecasting approximately $141 billion in 2026 and $144 billion in 2027. The main growth drivers should be wireless service revenue, broadband and fiber expansion, Frontier synergies, enterprise connectivity, and higher value bundled services. EPS growth is likely to be more impressive than revenue growth because of Verizon's cost-cutting program, lower subsidy pressure, and potential share repurchases. Current analyst estimates put 2026 adjusted EPS around $5.01, with 2027 around $5.28 to $5.29. Verizon itself raised its 2026 adjusted EPS guidance to $4.99 to $5.04 after the second quarter. Results. My base case forecast is approximately $5.02 adjusted EPS for 2026 and $5.30 for 2027. That would represent a meaningful improvement from the company's recent earnings trajectory. My base financial forecast calls for revenue of approximately $138.2 billion in 2025, rising to around $141 billion in 2026, and approximately $144 billion in 2027. That represents roughly 2% revenue growth in both forecast years. Adjusted EPS is estimated at approximately $4.71 in 2025, increasing to around $5.02 in 2026 and $5.30 in 2027. This represents approximately 6.6% EPS growth in 2026 and another 5.6% in 2027. Free cash flow could reach approximately $21.5 billion or more in 2026 and potentially grow toward $22 billion to $23 billion in 2027. These estimates combine current Wall Street expectations with my own conservative assumptions for 2027. Free cash flow may ultimately be more important than reported revenue for Verizon investors. The company generated $10.2 billion in free cash flow during the first half of 2026, and management expects full-year free cash flow growth of approximately 9% to 10%. If Verizon reaches roughly $21.5 billion or more of free cash flow in 2026 and grows that toward $22 billion to $23 billion in 2027, the company should have substantial capacity to fund dividends, reduce debt, invest in its network, and potentially repurchase shares. The dividend is arguably the biggest reason income-focused investors consider Verizon. The quarterly dividend is approximately $0.707 per share, or roughly $2.83 annually at the current rate. At a share price around $49 to $50, that represents a dividend yield of approximately 5.6% to 5.7%. Verizon has also increased its dividend for 20 consecutive years, demonstrating a long history of shareholder distributions. The key question for 2026-2027 is not whether Verizon can pay the dividend, but whether free cash flow continue growing enough to comfortably support it while the company invests in fiber and wireless infrastructure. At roughly $2.83 in annual dividends and approximately 4.15 billion shares outstanding, Verizon's annual dividend requirement is around $11.7 billion. Against a potential $21.5 billion or more of free cash flow, the dividend appears reasonably supported by cash generation. The payout is not risk-free because Verizon carries substantial capital requirements and debt, but the free cash flow coverage provides an important margin of safety. If management continues increasing free cash flow while maintaining moderate capital expenditure growth, I believe the dividend can remain sustainable through 2027. For my DCF model, I use a normalized 2026 free cash flow base of approximately $21.5 billion, modest long-term cash flow growth, an approximately 8% discount rate, and a 1.5% terminal growth rate. Because Verizon is a mature, highly leveraged telecom company, I prefer a relatively conservative discount rate rather than assigning it a high-growth technology company multiple. Under these assumptions, my estimated intrinsic value is approximately $85 to $90 per share. However, DCF models for telecom companies are extremely sensitive to the discount rate and terminal growth assumption, so this should be viewed as a valuation range rather than a precise price target. At approximately $49 to $50 per share, Verizon trades at roughly 10 times forward earnings, based on current 2026 EPS estimates. If Verizon reaches approximately $5.30 of adjusted EPS in 2027, and investors assign a 10.5 to 11.5 times multiple, the resulting valuation would be approximately $56 to $61 per share. This demonstrates an important point. The DCF can produce a much higher intrinsic value because of Verizon's substantial and relatively stable cash flows, while a market multiple approach produces a more conservative target. In my bull case, Verizon successfully maintains strong wireless subscriber growth, achieves the planned cost savings, generates stronger than expected free cash flow, captures meaningful synergies from Frontier, and benefits from increased demand for fiber connectivity from cloud and AI infrastructure. The company's $1 billion Google Fiber agreement also highlights the potential opportunity to monetize its network beyond traditional consumer telecom services. Under this scenario, I would assign Verizon approximately a 12 times 2027 EPS multiple on $5.40 to $5.50 of earnings, producing a stock target of approximately $65 to $70. Including dividends, the total shareholder return could be meaningfully higher. My base case assumes Verizon continues growing revenue around 2%, EPS around 5% to 7%, and free cash flow at a moderate pace. I assume wireless competition remains intense but manageable, while cost savings and broadband expansion partially offset slower top-line growth. Under this scenario, I estimate approximately $5.30 of 2027 adjusted EPS and apply an 11 times multiple, giving a price target of approximately $58 per share. Adding roughly $2.83 of annual dividend income brings the potential one-year shareholder value closer to $61 if the dividend remains unchanged. The bear case would develop if T-Mobile and AT&T intensify price competition, Verizon struggles to retain wireless customers, Frontier integration becomes more expensive than expected, interest expenses remain elevated, or free cash flow deteriorates. A weaker economy could also pressure enterprise and consumer spending. In this scenario, 2027 EPS could remain closer to $4.80 to $5, and the market could assign only a 9 times earnings multiple. That would produce a downside target around $43 to $45 per share. The dividend could cushion part of the downside, but investors should not assume that a high yield automatically eliminates capital risk. My 2027 bear case assumes approximately $4.90 EPS and a 9 times earnings multiple, producing a price target of around $44. The base case assumes approximately $5.30 EPS and an 11 times multiple, resulting in a target of approximately $58. The bull case assumes approximately $5.45 EPS and a 12 times multiple, producing a target of approximately $65. Meanwhile, my DCF valuation range is approximately $85 to $90 per share. The DCF produces a significantly higher number than the earnings multiple approach because Verizon's recurring cash flows are valuable. But I would not rely on the DCF alone. For a mature telecom company with significant debt and capital requirements, a blended valuation approach is more appropriate. Verizon is also beginning to position its network as infrastructure for the AI economy. The company has announced a major Google relationship involving fiber connectivity for data centers, while its broader fiber network can benefit from rising demand for cloud computing and AI-related data traffic. Verizon has also announced a Google Cloud partnership focused on artificial intelligence applications for customer service, network reliability, and employee productivity. These initiatives probably will not transform Verizon into a high-growth AI company, but they could create incremental revenue and efficiency opportunities. The biggest risk remains competition. T-Mobile has demonstrated strong wireless momentum, while AT&T continues investing heavily in its own network. Verizon, therefore, cannot simply raise prices without considering customer churn. Another major risk is leverage. Telecom networks require enormous ongoing investment, while Verizon already carries significant debt. Interest rates are therefore important. Frontier integration is another execution risk because the company must integrate assets while maintaining service quality and controlling costs. Finally, Verizon's relatively slow revenue growth means the stock is unlikely to receive the valuation multiples typically assigned to faster-growing technology companies. The bullish thesis becomes considerably stronger if Verizon continues producing net wireless subscriber growth, maintains approximately 9% to 10% free cash flow growth, reaches or exceeds its 2026 EPS guidance, and successfully integrates Frontier. Conversely, if subscriber growth reverses, free cash flow falls materially below expectations, or debt reduction becomes difficult, the valuation could remain depressed. Investors should therefore monitor postpaid phone additions, churn, wireless service revenue, broadband net adds, free cash flow, capital expenditures, adjusted EPS, and net debt every quarter. My final rating for Verizon at around $49 to $50 per share is hold, moderate BUY, for income-focused investors. I would not classify VZ as a high-growth stock. Its strongest characteristics are recurring cash flow, a large network, a substantial dividend, cost-cutting potential, and improving wireless momentum. The approximately 5.6% to 5.7% dividend yield provides meaningful income while investors wait for the operational turnaround to develop. For a long-term investor focused primarily on dividend income and capital preservation, I see Verizon as attractive around the current valuation. For investors seeking aggressive capital appreciation, however, the opportunity is less compelling because revenue growth is expected to remain relatively modest. My 2027 base case target is $58, bull case $65, and bear case $44, with dividends providing additional potential return. Therefore, my overall rating is hold, leaning toward buy, particularly on meaningful pullbacks rather than chasing the stock after a strong rally.